Hi everyone, this is StockJanitor. Welcome to my financial craft series. Today I'll be talking about psychological framework of stocks and conceptual idea of a stock. And today's three main topics will be about what is buying a stock, two important numbers of a stock, and psychological concepts of investing methods. If you like the topics I talk about, please subscribe to my channel. Thank you for the support. And I have a Discord channel that I share a lot of valuable information. You're always welcome to join. Add my Facebook and Wechat. If you have any questions, ask me anytime. I'll reply as soon as possible. Thank you. First, what is buying a stock? Buying a stock is basically buying a piece of company, becoming partial owner of the company. And through the company's business activities, it should profit from it. And then the earnings are split among owners, workers, or retained in the business for growth. Second, two important numbers of a stock. The first one is market price. The market price is the price you pay through brokerage every day to purchase the stock. And there is another number that's the value of the company. That's based on the company's fundamentals. So generally speaking, if the value of the company with stable growth and outlook, it will increase over time, as this yellow line right here. And market price will fluctuate, around it. If a company value increases at first, like Nokia, first the cell phone is released, uh, the future looks bright and the income increases, the market price for Nokia increases, right? And then suddenly another company took over, like Apple. They got a better product, it affected Nokia's income, and the future doesn't look as good, becomes gloomy. The market stock price will, decreases. This is just one example. So there are three investing methods. I'm gonna talk about the psychological idea of these type of investing methods. The first one, I want to talk about day trading and swing trading. These two are similar, so I put them together. They're more of a market-based profiting fluctuations, basically. So people, so it's like a voting machine. People think this stock is good, and most of the people buy it. The price will just goes up. They may not even pay attention to its value, most likely. And then when they don't like it, they sell it, so they vote no, and the stock prices declines. And what you try to do here is try to guess the people's reaction towards this stock. If you think, let's say at this point you think people will buy it more, so it will drive the prices up, so you buy it here and then sell it at top. And then, or when you think it hits the top for purchase, it's gonna decline. You can sell short. It's like a voting machine. Another example would be, let's say a house appraises 500K, and there are buyers that make multiple offers. Different buyers offer different prices. In a bear market, people tend to offer lower. Maybe they offer 400K, 420K, 450K, and at that time you're trying to sell your house. You want some money. 450K is the highest price, and then you may sell it for that point, right? And during a bull market, people offer more than the actual value, 510K, 550, and overall the highest bidder gets the house, and that's a bull market. But day trading and swing trading are basically making profits of these kinds of situations. So maybe let's say you go shop for a house, uh, the house appraises for 500K, there is no offers, and you offer 450 and the owner sells it for 450, and then you found another buyer for this house for 550, you make additional 100K profit. So it really depends on the people, that what they think the house price are worth, and you profit off the fluctuation and the different opinions of prices. And long-term investing is a little bit different. Long-term investing is really based on the value instead of the market price. The value of the company is based on fundamentals like financial background, financial statements, earning power, growth, and its other quality characteristics of its business. The market price will eventually reflect the value of the company. Over time, these market price and the value kind of fluctuate together. So for an example, it's like a marriage. You don't want to divorce unless real serious fundamental factors affects it. In a relationship, you're married, but your husband got another lady, and you found out you don't want to be with him anymore, so you sell it, you divorce with him. It's like a stock, for example. You buy this stock, its product is real good, it's making the best cell phone in the market, and the battery life is long, it's rock solid, it's a great quality, you like it. And suddenly, this one day, another guy came up with a genius idea. They make it, graphical. You can watch movies on your cell phone, and then the product just replaces the company you have. That's the time you might want to sell it quickly and switch over to a better quality company, right? I really suggest that market price should not affect your decision making, but although when you buy, you should always buy at a lower price. The lower the price, the more profit you have. And for example of long-term investing, a concept would be like purchasing a house again. If you buy a house today for 500K and it goes up for 520K after closes escrow, you're not going to sell it. You want to keep it for self-living, or you want to collect rent over a period of time. You want to put it there for the principal, the capital you invested to appreciate, right? uh, so after close of escrow, it goes to 450K. You don't want to sell it. You want to keep it. You're going to collect the rents, and you know that over time it's going to appreciate. And usually when you buy this house, you want the house to be a great condition, great quality, everything is good, uh, so on and so forth. And over a long time, your house value should dramatically increase if there's nothing wrong with the house and the quality of the house is perfect. It's like a stock. When you buy a really good company with high quality, great earning power, great fundamentals, the market price for that company, the stock price, will eventually reflect the value of the company. And over a long period of time, it's gonna grow more than inflation. So long-term investing is something you really want to research and find a good company for yourself, a stable one, that can make you profit, over a long period of time. You don't want a house with broken water heater or the air conditioning is not working, the design is weird and it's not remodeled, it's really old, it's 30 years old. You don't want those. You want something that's, up to date, it's solid, and everything's new or in a great working condition. So today I have talked about stock. What is a stock? It's basically a piece of company, and the company makes profit from its business and then splits the profit with shareholders. And there are two important numbers of a stock: the market price and the value price. The last topic I talked about was psychological concept of investing. Day trading and swing trading tend to be based on market prices and the fluctuation of market prices. And long-term investing should be based on the value of the company over time. And market price usually over time it reflects its value, and it fluctuate around the value of the company. And that's it for today. Thank you for watching. If you like the topics I talk about, please subscribe to my channel. Thank you for the support. And I have a Discord channel that I share a lot of valuable information. You're always welcome to join. Add my Facebook and Wechat. If you have any questions, ask me anytime. I'll reply as soon as possible. Thank you.